and welcome to a brand new episode of Market Manthan powered by ZBiz.com. Well, my name is Shatajananda, and today we have a very special guest with us, Abhishek Banerjee, who is CEO at Lotusdew. Well, welcome to the show, Mr. Banerjee.
Thank you, Kshitij.
Well, today we'll be talking about the most heated topic, and that is impact of Ukraine-Russia crisis on Indian markets, how to pick stocks, and what should be your strategy as well as LIC IPO. So stay tuned. Well, the first question I wanted to put it across to you, Abhishek, is that what does Ukraine crisis and in fact, why does impacting Indian equity markets help us decode why investors' portfolio are losing market cap, sort of on a daily basis?
Right. So, in the world of finance, everything is connected. And for the case of Ukraine, it's a very special connection. But before I establish the connection, I just want to tell you that there is a saying which goes that you should be buying at the roar of cannons and selling at the sound of trumpets.
Absolutely.
So it's a way of saying that whenever you see risk, it's an opportunity. But also, let's look at a historical perspective, right? For example, there have been umpteen wars in the past, including Kargil War in India. And if you look at the US market, right, out of the 19 episodes of a conflict, which included a military conflict, 11 of them, have given positive returns post-conflict or, during conflict. So the point is that it's not a kind of a sure shot thing that markets won't do well when there is conflict. The reason being that when there is a conflict, the government steps in to keep markets buoyant, because economy has to continue to fund the conflict. So therefore, that's an important aspect when looking at a conflicting situation. But now let's understand how is actually Ukraine relevant for somebody like who is investing in India, a retail investor in India. Where is the link and what's the link? So the link is like this. In the world, typically investors who are large pools of money, especially in the West, they look at emerging market as a total basket where they look at countries like India, Brazil, China, South Africa, and the likes as one cohort of emerging market, which includes Russia, right? And as we know, just today morning, Biden has said that they want to cut off new debt issuance by Russia from the Western dollar market, and that's just the first tranche of sanctions. So what's happening is that en masse Western investors are pulling away money from the emerging market basket, which includes, of course, Russia, but also India. And it's a bit of a case like the baby getting thrown with the bathwater, where just because of the flow, a lot of the money is flowing out of emerging markets and hence out of Indian markets. And the second confounding factor about that is that Western investors usually prefer quality as a factor in emerging market. And what you would see is that, it's typically the quality names that are kind of underperforming, and it's a trend that might continue. So as a factor-based investor, quality might be under pressure. However, we do things differently, of course.
No, absolutely. And in fact, we've seen this pain continuing post-budget. In fact, in the run-up to the budget, markets have been strong. And then post that event, and especially the Fed policy, things have sort of, went down for Indian markets. And in fact, if I look at the Nifty 50, which gave double-digit returns in the year 2020, it has, in fact, 2021 as well. It has turned negative for the year 2022, and in fact, it is down 7 to 8% from its height. So the story has not, exactly turned the way Indian investors would have wanted in this year. So what should be the investor strategy at this point in time?
Right. So, of course, when we came into 2022, there was already concerns in the market about, there being froth in the market. So it is not unanticipated that a correction would have come in.
Sure.
But I think, and looking at the last 7 days, the fact that Russia would so quickly and actually step into Ukrainian territory is a bit of a surprise to many investors, because it was like a Brexit moment where people kind of thought that it just won't happen.
Right.
So I think, we have seen what has happened in Brexit. Life continues and goes on, and there are opportunities, pockets of opportunities in different markets.
Yes.
Political and military conflict are part of shaping up of borders and world. So, it's something which will happen in some corner of the world or the other. However, in the case of India, right, among all the emerging markets, like I mentioned in the last piece or the last question, India is considered relatively a safe haven among emerging markets, and you would be surprised to know that pretty much many or most of the emerging markets governments have defaulted on their sovereign debt. In India, there has been not even one instance where they have defaulted on government debt. So in that sense, India is considered to be a safe haven of store of value and assets, which again, will be a tug of war between what I said, the last question, where en masse people pulling out and then maybe people coming back into India as a overweight in emerging market versus any other market, and hence again quality factor being a bought sector. Right. We don't know which of these two forces will eventually win, but what we do know is that when you're caught in the flow, it's better to kind of park yourself in more domestic smaller cap companies who might be offering niches where they would not get dragged down into the tiding and ebbing of flows of from foreign portfolio investors.
So stay with market leaders, at least definitely from a broader market standpoint. Now, if you look at investing, from a global perspective, the equity markets across the globe are under stress, and how can investors stay ahead? One is that, and other one is, do you recommend investing in a diverse portfolio of global equity? And how do you pick stocks, when we're talking about a global portfolio at this point in time? As you already pointed out in the in the interview that you buy stocks when there is stress, when there's fear, and the good part is that the situation is same across the globe at this point in time as well.
Yeah, there are certain learned lessons, right? Markets climb a wall of worry, so markets need to climb onto something, and worry is a solid kind of a foundation on which the markets happen to climb. I think that's true. I've seen that happen in many cycles. So it's when people are worried, you'll see the markets creeping up, and the euphoria is just before the markets are about to correct, anecdotally. Sure. My opinion is that, when markets are under stress, you should stick to more kind of mainstream asset classes. That includes, staying away from things like which are crypto in nature or things which do not have a very established track record of precedence, right? There's nothing wrong about crypto assets. It's just that something which has a larger history, you can kind of estimate the future based on the history a little better. And that's kind of my opinion there. The main thing about global portfolio, right? So why we want to encourage people to do that. If you look at globally what's happening, borders are getting erected, and borders are becoming more and more brittle and less porous. Right. So there's a nationalistic sentiment across all countries where they want to encourage their local businesses, they want to encourage their local products, they want to rely less on imports and more on exports. And when this is happening, you will have large companies like the Teslas and the Googles and the Facebooks of the world, which will do business everywhere in the world. And you'll have very small companies who dominate local niche markets, right? And things in between will have to figure out which of these two, sides of the fence they want to lie on. And when this is happening, what you could do before as a domestic investor, like you could buy a TCS, which has revenues in Africa, Europe, India, Japan, US, and so on. You could essentially harness the power of global revenue using one locally listed stock. So that model itself could be under pressure, where it would be harder and harder for one, centralized service center or a centralized manufacturing base to service across the world. And what this opens up over the next 20 years are opportunities for individuals to, do the self-diversification, which means that understanding that they need to be investors in local economies which are not their own domestic economies, and we kind of think that that's the trend that might play out for the next 20 years. What we do in Lotusdew is different, right? Lotusdew is essentially a deep tech company, and we focus on use of public disclosures, artificial intelligence, tenets of behavioral finance, to identify and analyze investment behavior of investors across the world, including creating our own alternate data set, which we rely upon, and our technology. And using that, we are able to screen stocks, not just in India, but also outside India, like US. And hence, with our process, we are able to create bottom-up portfolios of listed US equity in the small cap category and offer that to investors who are looking for foreign equity exposure.
Right. Now, if you move away from geopolitical concerns, there's another factor which retail investors are really positive on, or they're looking forward to. One is the LIC IPO. So would you think that would that crowd out other offering? And is it a bad time for the life insurer amid the muted sentiment?
Right. So, LIC is very important, right? If you look at the total assets of LIC.
From a divestment point of view, from the government point of view?
Both, right? So I will touch upon a few points. So first is the total monetary base of LIC is actually higher than the total mutual fund market that is there in India. So it's a very dominant player, and to be part of, it's like buying all the asset management companies that ever existed in India, right? So it's kind of that kind of a company. So it's an insurance business. Insurance and capital markets are under-penetrated. So it's a very attractive opportunity. They are actually offering stocks to their own policyholders, which is for the first time.
Sure.
On the other hand, this diversification or divestment from the books of the asset base of the government creates opportunities for government to spend more without increasing the borrowing. So that has an impact on overall currency and hence inflation, which might actually keep equity prices inflated, as lower inflation means lower rates, which means higher support for higher multiples.
True.
On one hand, this is a fact. On the other hand, the fact is that it's a very well-known brand and a lot of retail investors will participate and park their money. I think it'll probably be an oversubscribed IPO, and there will be a short period of time when people will park their money to kind of get subscription, but a lot of that will again come back to the market. So on an average, I think it's an important historic event, but in the context of overall market, I don't think it's going to lock away capital in a way that it's not available for the right companies.
Right. So this brings to my next question. So where smart money seems to be moving, many high P stocks seem to be going through a reversal, while low P stocks are getting traction, or you could say buying interest. So what does the data tell us?
So I just think that, the reason we have been able to sustain higher P stocks for a long time is the fact that interest rates have remained anchored low. And if you just think about it, the discounting of the future value of a company, which is a function of the interest rate as a denominator, or the smaller the interest rate is, the higher the valuation of the company appears to be, because further out cash flows, they are discounted less, and they're more, kind of the value of that cash flow is more available in the present at the present value. As anticipation of interest rates are higher, investors are kind of repricing this stock to say that no, future growth cannot support that kind of P multiples for the kind of interest rates that we expect is going to happen. I think, if you look at over a longer period trend, right? When I'm talking longer, I'm talking about 10, 20, 30 years. Right. What will happen in the world, we will see is that the basic needs, the so-called consumer staples, will be the responsibility more and more of the government. So it will be more developed the countries, the more social inclusion they will offer in terms of housing, in terms of food and basic, amenities. Right. And in such a world, inflation is the expectation of basic necessities that and the increase of prices. I think inflation, the way we have seen it in the last 50 years, is not how we are going to see in the next 50 years, where inflation might happen, but only in the maybe upper middle class to luxury segment, where there is aspirational demand, right? For basic demand, I think it will be pretty much price controlled or provided for. So in that view, I do think that there is still room for companies with higher PE multiples to be supported. Though what we are seeing is in the case of India, India has always traded at a premium in terms of PE compared to rest of the emerging markets. And the anecdotal reason is that there is higher PEs paid for higher level of corporate governance. So the trust is implied in the price by a higher PE. So if you remember, like what I mentioned in the beginning, what we are seeing is this precisely these high quality companies kind of getting sold, right? Because that's really the part of the investment basket of the most Western investors. So that could be the second reason. But I think, in my personal opinion, the second reason is more dominant now. And what I was talking about before is more a 20-30 year play, which is something which we worry about in the near future. But a lot of it can be explained by the redemptions by passive funds, which are just kind of pulling away money from the passive weights that are there in different emerging market indices like MSCI Emerging Market Index, or a different index that other investors might follow. And most of these indices, though they're passive, they actually include the high quality stocks in India.
Right. An interesting conversation there, Mr. Banerjee. So thank you so much for your time and your insight on markets as well as global markets. Well, that's all for now, but do stay logged on to zeebiz.com for more on news, business, and economy. Thank you so much for your time, sir.
Thank you very much. Thanks. Have a nice day.